Welcome back to the Deep Dive. Today, we're doing something a bit different, something really structured. We've got a 5-part earnings analysis report on a company called Poet Technologies, and our mission is to walk you through it, slide by slide, to get to the real story.
And you really need that structure here. I mean, this company, Poet, is in such a critical and, frankly, a really difficult phase. They're trying to make that leap from just being a pure R&D shop to a full-blown commercial manufacturer.
The infamous Valley of Death.
Exactly. And when you're in that valley, the standard financial metrics, they can be all over the place. They get super volatile, often pretty misleading if you just take them at face value.
Right, and that's what we saw happen. The stock dropped, I think it was 6.4% right after the earnings release. That's the headline noise. But our goal here is to dig deeper, to move past that, and really separate what's just, accounting noise from what's actual fundamental progress.
And that's the core tension for you to keep in mind throughout this whole deep dive. You have a company spending cash like it's a mature, scaling business, hiring, expanding, but its revenue still looks like a startup. So we have to be almost surgical in how we separate things like non-cash accounting quirks from the big strategic bets they're making.
Like that huge jump in R&D we're going to talk about.
Precisely. That's the engine of the real story here.
Okay, fantastic. So let's jump right in and unpack this thing systematically. All right, so starting with slide 1, the at-a-glance scorecard.
Yay!
And the first number that just jumps off the page is the revenue headline. It looks explosive.
It really does.
The company reported nearly 8,000% increase in year-over-year revenue. To be exact, it was 7,998.6% growth.
Which is an incredible number to see in print.
Yeah. They reported revenue of $290,434 in Q3 2025, and that's up from a tiny base of just $3,685 in the same quarter last year. A number like that, just screams hypergrowth.
And this is where, we have to immediately pump the brakes. It's our first and maybe most important point of caution for you. That percentage is a textbook example of the low base effect.
Okay, so explain that.
Well, when your starting number, your Q3 2024 revenue is barely $4,000, I mean, almost any sale is going to create a sensational-looking percentage. It's mathematically true, but it's not economically meaningful in the way you'd think.
So in professional analysis, you just kind of look past that.
You have to. You acknowledge it and move on. What really truly matters is the absolute dollar amount and, more importantly, how that number stacks up against what the market was expecting.
Right, the expectations. And we'll get to that miss in a second. But first, let's stick with the reported numbers and look at the bottom line, because they did show some pretty solid improvement there.
They absolutely did. And you'd expect to see a net loss for a company in this phase. That's normal. But the loss narrowed pretty materially by 26%. It went from about a $12.7 million loss last year down to a $9.4 million loss this quarter.
And that flows right down to the earnings per share, the EPS.
Yeah, diluted EPS improved by 45%. So it went from a loss of 20 cents a share down to a loss of 11 cents, a very significant improvement on paper.
Okay, and that brings up a really crucial accounting point that we need to clarify, especially for anyone looking at these kinds of pre-profit growth companies. It's the difference between basic and diluted EPS when you're reporting a loss.
This is so fundamental. People get tripped up by this all the time. So basic EPS is easy, right? It's just your net income, or in this case, loss, divided by the shares that are actually out there. Simple.
But diluted is supposed to be the more conservative number.
Supposed to be. It's meant to show worst-case scenario. It includes all the potential shares that could be created, from things like stock options, warrants, convertible debt, you name it. If a company is profitable, adding all those extra shares to the denominator makes the earnings per share number go down. It dilutes it.
But the rules flip completely when there's a loss.
They do. The accounting standards call these potential shares anti-dilutive in a loss scenario. Think about it. If you take the same dollar loss and spread it over more shares, the loss per share actually looks smaller. It looks better.
Which would be misleading.
Totally misleading. So the standard says you can't do that. You have to exclude those potential shares to avoid making the loss look artificially good. So for Poet this quarter, the basic and diluted share counts were pretty much the same because of that rule.
That is a crystal clear explanation. So with that in mind, you've got this 8,000% revenue growth. You've got a 45% improvement in EPS. Why on earth was the market so tough on them?
Because the market is forward-looking and impatient. It doesn't really care about how they did a year ago. It cares about how they did against what analysts expected them to do this quarter. And on that front, they missed. It was a pretty significant miss on both the top and bottom lines.
The market disconnect. Let's get into the specific numbers on that double miss.
Sure. The Wall Street consensus, so the average analyst estimate, was for a revenue of around $553,000. Pierrot came in at $298,000.
Wow, that's not even close. That's a miss of almost 50%.
It's a big miss, and it immediately sends a signal to the market that the timing of this big production ramp, it's just not happening as quickly as everyone hoped. And then the EPS miss naturally followed. Analysts were looking for a loss of 9 cents, and POIT reported a loss of 11 cents.
A double miss.
Yeah.
The market never likes that.
Good.
And the stock reacted, down 6.4% on November 14th, the day of the release. So what did that do to the overall analyst sentiment?
It just shifted everything into a much more cautious gear. It's what we call a show me story now. The market is basically saying, okay, we're done giving you credit for cool technology and developmental milestones. We need to see you execute. We need to see the revenue. The window for just making promises is closing.
And that skepticism really comes into focus with our next big analytical point here, which ties that huge revenue percentage back to the loss improvement. We're talking about the lack of operating leverage.
Yes, this is the defining math of this first slide. You've got this incredible 8,000% revenue growth on one hand, but the net loss only got better by 26%.
That's a huge gap.
A massive gap. If there were real operating leverage at play, that astronomical revenue growth would have just sliced through the losses. You'd have seen the loss narrow by, I don't know, maybe 70 or 80%. The disconnect between those two percentages tells you everything you need to know about their high fixed cost structure.
Okay, so let's define that. If operating leverage is basically your ability to grow revenue way faster than your costs, why doesn't a company like POIT have it yet?
It's a simple matter of scale. Even with that big percentage jump, the absolute dollar amount of revenue, just under $300,000, is still, it's de minimis. It's a drop in the bucket compared to the enormous fixed and semi-variable costs you need to run a global semiconductor operation.
And what's key here is that they're not just maintaining those costs, they're deliberately making them bigger.
That's the strategic counter-narrative. The biggest reason profitability looks so far away is because they made a conscious choice to accelerate their investments, especially in R&D. Research and development expenses more than doubled. They went from $1.8 million to $3.7 million. You just can't get to profitability in the short term when you're strategically flooring the gas pedal on investment like that.
So the goal isn't profit right now. It's readiness.
It's readiness. It's technology dominance. That's the priority. And that $3.7 million R&D number is the perfect bridge to our next section, where we really get into the nitty-gritty of that cost structure. All right, so if slide 1 was the high-level scorecard, slide 2 is where we need to put on our forensic accounting hats and peel back the layers. For a company like POIT, trying to use traditional ratios like gross margin, it's just pointless right now.
Because they're still so far from being profitable on a per-unit basis.
Exactly. I mean, a $9.4 million quarterly loss on less than $300,000 in revenue tells you all you need to know. They're burning a lot of capital just to keep the lights on and build the foundation.
So the key metric to watch isn't margin. It's something else.
It's R&D intensity. We just mentioned that R&D costs hit $3.7 million. That number absolutely dwarfs their revenue. That intensity, that's your best leading indicator. It tells you the company is making the right sacrifices today to fuel tomorrow's growth.
And management was very specific about why that R&D number more than doubled. This wasn't just, runaway spending.
No, and this is maybe the most important operational insight in the whole report. They explain that their R&D is evolving. It's shifting away from what you call pure research, which can be relatively cheap, modeling on computers, early lab work, and moving into product development.
And that's a whole different ballgame in terms of cost.
Oh, it's incredibly expensive. Help us visualize that. What kind of activities are we talking about inside that R&D jump?
Okay, so think of it this way. Pure research is like writing the blueprint for a car. Product development is building the factory, building the crash test prototypes, and running them into a wall 100 times to make sure they're safe.
So we're talking about real physical things.
Exactly. We're talking about booking time at a silicon foundry, which is hugely expensive, buying specialized high-precision testing and alignment equipment that can cost millions of dollars per machine, paying for third-party, rigorous qualification testing. All of that costs a fortune. But it's the only way you prove to a Tier 1 customer that your product is ready for prime time. That spending is what backs up the $5.6 million backlog we're about to talk about.
Okay, that makes perfect sense. So the cost increase is not only justified, it's absolutely necessary. Now, let's tackle the accounting confusion. The GAAP versus non-GAAP noise that actually made the bottom line look better than the real operational picture.
This is so critical. The net loss narrowed by 26%, which sounds great. But the real core operational spending, stuff we just talked about, went up dramatically. The reported number got better because of a non-cash accounting quirk.
And the biggest culprit, the single item causing all this volatility, is something called the derivative warrant liability.
Right. They reported a $2.4 million non-cash loss from this. It's a bit of an esoteric concept, but we have to break it down.
Let's do it. So first, warrants are basically just stock options. They give the holder the right to buy the company's stock at a set price in the future.
Okay, simple enough. But why does it become a liability that swings around so much?
The volatility comes from a specific accounting rule. It happens when the warrants are denominated in a different currency than the company's main reporting currency. So POIT reports in US dollars, but let's say these warrants were issued in, for example, Canadian dollars.
And that mismatch creates an issue.
It does. International accounting rules say that if you have that currency mismatch, you have to treat the warrant as a liability on your balance sheet. And every single quarter, you have to reevaluate its fair value. You have to mark it to market based on changes in both the stock price and the currency exchange rate.
So if the stock price goes up,
If the stock price goes up, the warrant becomes more valuable to the holder, which means it's a bigger potential liability for the company. So paradoxically, when the stock does well, the company has to record a theoretical non-cash loss on its income statement. No cash actually moves, but the bottom line gets hit.
and the magic, so to speak, for that 26% improvement in net loss becomes clear when you compare this quarter's number to last year's.
That's the whole trick. In Q3 of last year, 2024, this non-cash charge was a massive $6.2 million. This quarter, it shrank to $2.4 million. So that non-cash charge got smaller by $3.8 million.
Which is the main reason the total net loss shrank.
It is the primary mathematical reason the reported loss went from $12.7 million down to $9.4. The real operational cost went up, but this accounting noise completely masked it.
So an investor just looking at the headlines would get the completely wrong idea. They'd think the company was tightening its belt, when in reality they were hitting the accelerator.
A perfect case of an accounting entry creating a false narrative. And it wasn't the only non-cash item moving around. We also saw an increase in stock-based comp, or SBC.
Right, SBC went up to $1.9 million from $1.5. And while that's non-cash, it is a real economic cost to shareholders.
It is. It's dilution. But it also confirms they're aggressively hiring and trying to keep top-tier engineering talent. At this stage, you have to conserve cash, so you use your equity as a form of currency to attract the people you need to execute the ramp.
And the last piece of the puzzle, the physical evidence of scaling, is the increase in depreciation and amortization.
Yeah, that figure went up to just under $1 million. It's a subtle clue, but it's important. When D&A goes up, it's confirmation that the big capital expenditures are actually happening. They're buying the machines, installing them, and getting them ready to start producing in volume.
Okay, so let's summarize slide 2. R&D is skyrocketing, which is a bullish signal of product development. SBC is up, meaning they're hiring. Depreciation is up, meaning they're installing equipment. And a weird warrant liability quirk is hiding all that increased spending, making the bottom line look deceptively better.
That's a perfect summary. It's the financial picture of a company gearing up for war.
All right, let's shift gears from the costs to where the money is, or at least where it's supposed to be coming from, the revenue. And the big story here is this metamorphosis in what kind of revenue POD is generating.
Yeah, for years, they were basically a high-tech consulting firm. They made money from what's called non-recurring engineering fees, or NRE.
Which is a lumpy one-off project work.
Exactly. It's not scalable. Every dollar of NRE revenue requires a proportional amount of an engineer's time. It's great for proving your technology works, but you can't build a massive company on it. The big milestone this quarter is that qualitative shift from NRE to actual product sales.
The report mentions small product revenue. Now, that sounds insignificant, but why is that actually a huge deal for a company at this stage?
Because it's proof of life for the entire manufacturing supply chain. It means they've gone from a design on a computer past the prototype stage and have actually shipped a finished good that a customer paid for. It validates the whole system from the foundry to the packaging to the logistics. It proves the machine works.
But as we said, the amount of revenue they actually recognized, that $298,000, was a letdown for the market. The real story, the operational truth, is hidden in the forward-looking data. We're talking about the committed backlog.
This is it. If you're an investor, this is the number that should make you sit up and pay attention. The company confirmed they have 2 successive initial production orders from 2 key customers valued at over $5.6 million.
And this isn't just a letter of intent. This is a purchase order.
This is money on the books. This is a commitment, and it's pivotal for 3 big reasons.
Okay, let's break those down. Reason number 1.
Validation. These aren't small customers. These are tier 1 players, the big dogs in data centers or telecom. These companies have brutal multi-year qualification processes. Getting a production order means your technology has passed every single test. It means the optical interposer works, it's reliable, and it's ready for commercial deployment. It's the ultimate seal of approval.
Okay, that makes sense. Reason number 2.
Visibility. This backlog gives management credibility. They can now stand up and give concrete guidance based on a real order book. They said these orders are the beginning of a revenue ramp, which we expect to increase steadily throughout 2026. It gives everyone a tangible baseline to work from.
And reason number 3 is just the pure math of it, the scale.
The comparison here is it's just stunning. That $5.6 million backlog is nearly 19 times the revenue they actually recognized in Q3.
19 times.
19. It completely reframes the Q3 revenue miss. It suddenly looks less like a demand problem and more like a simple timing issue. The revenue recognition just lagged. The demand is clearly there. It's just sitting in the backlog waiting to be fulfilled and invoiced.
So the market's 6.4% sell-off looks incredibly short-sighted in that context.
It's the classic conflict between short-term market impatience and the long-term reality of a manufacturing ramp-up.
Okay, but let me play devil's advocate for a moment. That $5.6 million backlog is great, but they just missed their Q3 number by a mile. Why should we trust their guidance about a steady ramp in 2026? Isn't it possible they're being overly optimistic?
That is exactly the right question to be asking, and it's the question that's priced into the stock right now. That's the execution risk. The reason to have confidence in the guidance isn't just because management said it, it's because of the investments they just made and the partners they have.
It all connects back to that R&D and CapEx spend.
It does. They've spent the last year pouring money into manufacturing readiness, that's the rising DNA, and hiring the people they need, that's the rising SBC. The $5.6 million is the validation that the tech works. The $250 million war chest we're about to discuss is the insurance policy that guarantees they can solve any manufacturing hiccups that come up along the way.
Okay, that's a very strong defense. Now, beyond those direct orders, let's look at their broader strategy. They're not going it alone. They're building an ecosystem through key partnerships.
Which is the only smart way to do it in deep tech. You leverage the sales channels and market access of established players, and they're doing it across a few really critical verticals.
Let's start with the hottest one, AI and data centers.
Right, and here the key partner is Semtech. They've jointly launched a 1.6T, that's 1.6 terabit optical receiver. Now, for you listening, 1.6T is the absolute bleeding edge of networking speed needed for these massive AI training clusters.
And why is 1.6T so much harder than the 800G we have now? What makes POIT's tech so critical at that speed?
It's a problem of density and heat. To move that much data, you have to cram an insane number of optical components, lasers, detectors into a tiny space. This creates a ton of heat, and everything has to be aligned with near-atomic precision. POIT's optical interposer platform is designed specifically to solve those two problems. It manages the heat, and it allows for passive, almost automatic alignment of all the parts. It's what makes 1.6T manufacturable at scale.
Okay, so that's the bleeding edge. What about the next big architectural shift? I'm talking about co-packaged optics, or CPO, and their work with Sivers Semiconductors.
CPO is the holy grail. The idea is to move the optics off the front of the server and put them right inside the package, sitting next to the main AI chip. This slashes the distance the signals have to travel, which saves a massive amount of power and reduces latency.
But that architecture needs a whole new kind of light source.
It does, and that's the partnership with Sivers Semiconductors and their Starlight strategy. CPO needs powerful, efficient external lasers that can pipe light into the chip package. This collaboration ensures that POIT's interposer platform is being designed and optimized today for the light sources of tomorrow. It future-proofs their position.
And finally, they're being smart and diversifying beyond just the data center.
Yes, their partnership with NTT Innovative Devices gets them into the mobile networking space. We're talking about the front-haul infrastructure for 5G and future 6G networks. It's a huge market, and it means their entire business isn't held hostage by the spending cycles of just a handful of cloud giants. It's a really robust, multi-pronged strategy. So we've talked about the plan, the backlog, the partnerships, but that transition from R&D to full-scale manufacturing is just brutally expensive. So now we have to look at the balance sheet. Do they have the cash to actually survive long enough to deliver on that $5.6 million backlog?
Well, looking at their cash burn, their cash flow from operations was a loss of $2.8 million for the quarter.
Yeah.
And that's just the cash to run the day-to-day business.
Which, honestly, for what they're trying to do, that's a pretty efficient burn rate. It shows good discipline. But still, almost $3 million a quarter adds up really fast. And that is why the single most important event this quarter was what I'd call the deployment of their strategic weapon.
You're talking about the capital raise, the massive strengthening of the balance sheet.
Massive is the right word. Through 3 rounds of financing, they raised gross proceeds of $250 million.
$250 million.
Yeah.
You really have to put that number in perspective.
It's completely transformative. For a company burning less than $3 million a quarter operationally, this kind of cash injection changes the entire risk profile of the investment. It essentially eliminates the financing overhang risk that just strangles so many companies at this stage.
That fear that they're going to have to do another financing round in 6 months from a position of weakness.
Gone. That risk is off the table. This gives them years of runway. They have crossed the financial valley of death. And it signals a huge strategic shift. From playing defense, just trying to survive, to playing offense, focused purely on growth and expansion.
Okay, but I have to push back here a little. $250 million is a ton of money, and it came at a cost to existing shareholders, right? There was significant dilution from issuing all those new shares between $5 and $7. How do we know this capital won't be wasted?
It's a 100% valid and critical concern. As soon as you solve the solvency risk, the focus immediately shifts to capital allocation risk. The danger isn't running out of money anymore, it's the danger of wasting it. But management has been very clear about the use of proceeds.
So what's the mandate for that cash?
It's earmarked for 2 things, and 2 things only. 1, internal expansion of development and manufacturing capability, so the R&D and CapEx we've been talking about to deliver that backlog. And 2, and this is new, inorganic growth through acquisitions.
So M&A is now on the table.
It's a powerful new tool in their toolbox. They can now go out and buy a company with a complementary technology, or acquire a piece of their supply chain, or even buy manufacturing capacity outright to speed up their timeline.
So to the dilution question. The bet for shareholders is that the return on invested capital from that $250 million will be far greater than the short-term pain of the dilution.
That is the core bet of every growth investor. They are betting that owning a smaller piece of a much, much bigger, more stable pie is a better deal than owning a larger piece of a company that could go under at any moment. Shareholder rewards like dividends. Not even a consideration right now. It's all about growth.
And let's just touch on the operational benefit this cash gives them. Their solvency status.
It's a huge operational advantage. When you walk into a meeting with a Tier 1 customer and you have $250 million in the bank and no real debt, you are a credible, stable, long-term partner.
Those big customers won't risk their supply chain on a company that might not be around next year.
Never. This capital raise tells them POE is here to stay, which makes it much easier for them to sign those huge multi-year volume contracts. It transforms the sales conversation.
Okay, so we have dissected this from every angle. The revenue, the accounting noise, the backlog, the war chest of cash. Let's bring it all together now with management's forward view. What was the core message from the CEO, Dr. Suresh Venkasan, about 2026?
The message was one of unwavering confidence, but it's a confidence that is now backed up by tangible assets, the cash and the orders. He was very clear that Q3 wasn't a failure, it was just the prelude. He said the production orders are, and I'm quoting, the beginning of a revenue ramp which we expect to increase steadily throughout 2026.
And that phrase, steadily throughout, is key. He's managing expectations. He's not promising a vertical hockey stick in the next quarter.
Exactly. It's going to be a gradual, phased ramp up. And he also doubled down on their high-end strategy. He pointed specifically to that 1.6T receiver partnership with Semtech and said it enhances POET's product leadership into the highest performance segments of of the AI interconnect market.
So they're not going after the low-margin commodity stuff.
Not at all. They're aiming for the very top of the pyramid where the technical barriers are highest and so are the potential margins. And of course, he reiterated that strategic flexibility they now have, that dual focus on internal expansion and inorganic growth. We should all be watching for potential M&A news in the coming year.
All right, let's distill this entire deep dive down to the ultimate actionable takeaways for you.
I think we can boil it down to 4 key points that really cut through the noise.
Okay, key takeaway 1, backward versus forward.
Simple. The backward-looking Q3 revenue miss of, $298,000? It's basically irrelevant when you weigh it against the forward-looking $5.6 million backlog from Tier 1 customers. The miss was a timing issue, not a demand issue.
Key takeaway 2, balance sheet reset.
The $250 million raise was the most important event of the quarter, full stop. It takes liquidity risk completely off the table for the foreseeable future and lets the team focus 100% on execution. Key takeaway 3, the ecosystem play is essential.
Right. You can't win in semiconductors alone. The partnerships with Semtech, Sievers, and NTT show they are smartly leveraging established players to get their technology into every important high-growth market.
And finally, key takeaway 4, the cost of scaling is the true story.
This is my favorite one. If you ignore that weird non-cash warrant accounting, the real operational story was the doubling of R&D spend to $3.7 million. That spending isn't a bug, it's a feature. It's the bullish signal that they are spending the money necessary to deliver on their promises.
So when you pull all of those threads together, what's the final thesis? What's the fundamental narrative shift for POET?
Well, for years, the big question hovering over the company was, does this optical interposer technology actually work? Can it perform at an industrial level? And that $5.6 million backlog from very picky customers answers that question with a definitive yes.
So that question is answered. The new question, the one the entire investment thesis now hinges on, is different.
What is it?
The new question is, can they manufacture it at scale and execute the 2026 ramp efficiently? The stock price decline reflects the market's impatience and skepticism about that execution. But the fundamental building blocks, the cash, the confirmed orders, the partners, are all now in place. That wider operational loss we dissected isn't a sign of failure. It's the price of admission. It's the cost of earning the right to answer that critical scaling question.
An incredibly dense quarter. But using a structured framework like this really does help filter out all that noise and focus on what's strategically important. It's the only way to do it. Before we wrap up, we have a couple of important disclaimers we need to state. Financial disclaimer. This report is for informational purposes only and does not constitute financial, investment, legal, or tax advice. The information contained herein is not a recommendation or solicitation to buy, sell, or hold any securities. All investment decisions should be made based on your own research and in consultation with a qualified financial professional. While efforts have been made to ensure the accuracy of the information, no guarantee is provided. AI disclaimer. This report was generated by an artificial intelligence model. It integrates data directly from the company's official earnings press release with publicly available market data obtained via real-time web searches. Although the AI is designed to adhere to strict data sourcing and verification protocols, errors or omissions may still occur. All information, including financial data and calculations, should be independently verified by the user before making any decisions. Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.